Hi traders. Okay, so I've in the last 60 videos or so have sporadically covered bits and pieces of price action and a number of strategies and things that you should look for. And I think it's time that we started putting all of that information together and then applying it to binary, to Nadix, and also to Forex trading. Now, I've always stated that the perspective that you need to take in trading all three of them should be from a Forex point of view. Okay, what does that mean? That practically just means where you need to understand what the Forex market is, because with binary, you're trading within the confines of that. And by that I also mean that when you understand how the Forex market moves and what makes it move, the cycles it actually takes, then you'll better understand how to then apply your binary options strategies to that. Now, I want to make this actually very clear. I'm going to create another video about this, a short one, to do with strategies per se, okay, where all strategies actually work. A lot of mistakes that traders make is where they'll trial something briefly and then they'll say this isn't working and I will jump onto something else. I'll go find another strategy. And you're constantly jumping from group to group, paying signal service providers, learning various things, going to pay money for expensive strategies and then coming back and saying, why isn't this working? In the defense of signal providers, in the defense of all these strategy providers, I want to say this to you. From my years with trading, I've understood one thing very well, that all strategies work extremely well. What differs between whether the strategy leads you to a win or a loss is in your ability to apply it to the right market conditions. And this is what makes Forex trading or binary options trading so difficult, is that a lot of the times the trader relies upon the strategy to get them the win, but the strategy really should inversely rely on the trader to apply it to the right market conditions. Now, in this video, we're going to cover market cycle, and so that hopefully this helps you then apply whatever strategies you are working with, whether they're ones off my channel or other strategies, doesn't really matter. You can then apply the strategies to the right market conditions, and that should increase your win rate and result in more confidence for you. Okay, so let's do this first of all. Now, when I'm talking about a market cycle, I usually talk about how at the inception of the week. Okay, so I would cover the full 5 or 5.5 days as being where you need to fit a market cycle into. Okay, sure, it's not going to be the case. Sometimes the market will move over the course of a month, and then over the course of a season, and then throughout the year as well. So, but for all extents and purposes, and how we're going to trade all of this, you're going to apply it weekly. How you're going to do it is by looking at it in a specific directional flow. And what I mean by that is this. Now, some of you might be familiar with Elliott waves. Some of you might not be. It doesn't matter if you're not, because I don't want you to jump into specifics of it. All I want you to understand is this. You know how when we talk about double tops or double bottoms, at the inception of the week, whether it be just Asian session Monday, or if it goes all the way from Asian session Monday to London session, New York session, and even might go to Asian session Tuesday, so the next morning, where the market will go through a process of establishing a structure, right? What I mean by that structure, and see if I can find an example just quickly. Okay, here. This is Monday morning on Euro USD. Let me blow that up a little bit. Basically, what we're doing here is looking for the market to establish something that gives us some idea of a directional flow. So I've got a a horizontal box here. Basically what I've done is I've watched the market flow down, hit the bottom, climb back up again, come back down, and this is a critical moment where I'm looking at it, which is towards the end of the Asian session on Monday. Market comes down, and then this big green candle pushes out of there. Now this is still not London session opening, this is Frankfurt, these four candles here. So what I'm waiting for is some degree of a false move or massive wick creation somewhere that lets me know that the market is going to start heading in this direction. So although looking at it you might say, well, this doesn't really look like a clear W for me, so you could say this: here's the first wave, second wave up, third wave down, and this whole jumble up here is actually the fourth wave going up. Now, where would I take a trade? Forex wise, I'd take it up here. Why? There's too much jumble up here. So notice this, I'd want price to completely break outside of most likely this area here. This one, you could have said, yes, price was going up. You could have counted these wicks. If it's too much like this, then if it's too choppy, wait. And the reason why I say wait is because, say for instance, you're only needing to collect 30 to 50 pips. By losing, say, on here, this is only 10 pips. By losing 10 pips doesn't mean you're not going to get to 30 to 50 pips. And here's the difference also between jumping in too early and risking a loss, or taking your time and waiting for the market to do exactly what you want it to do. So here's the thing. Once the market jumps out of the box, I'm expecting, especially around the EMA 50, that this is going to slow down. Maybe they're going to consolidate briefly. They might even push the market back lower, maybe do another stop hunt low. And the reason for that is to, one, to filter out those traders that are impatient, and two, to fake us out and make us believe that the market's going to head back down again, right? But once this happens, I know this is a double bottom. So what I would do is then at some point within this 30-minute range here, I'd possibly take a trade going up, right? Now, binary wise, what you could do here also is take a longer term trade going up, especially after this point here, when price comes back down, finishes off here, fails to come back down and break this low. What you could do is take, and if you want, you can wait for an additional confirmation here, but what you could do is somewhere along these lines here, do an Eod trade, a call. Market closes all the way up here. What would have happened most likely is that market goes up at some point here. Actually, it does do it here. See how it pushes back down at the start of the New York session, creates a wick, and then climbs again. Market cycle, and this is what we're looking for, would say that initially on a Monday, at some point, either Asian session, could happen in London session, could even go all the way down to Asian session the next day, will create either a double bottom or a double top, right? With me so far? Now, when we're doing that, this is what I'm looking for. I'm expecting that somewhere here is, click on that, somewhere down here is my double bottom. This wave here that I'm seeing, this line, is the fourth wave of my double bottom. So I would expect this wave here to be this, right? What I'm expecting is for the market to go up, come back down, go up, come back down, and then go up once again. Okay, so if you see a double bottom, this is the market cycle that you'd be expecting. And the inverse is also correct. If it was a double top that the market created, then this would have been reversed. So this would be the market comes down, gives me a 1, climbs up, gives me a 2, climbs down, gives me a 3, climbs back up, gives me a 4, and then pushes down to a 5. Once it gets to the fifth point is where I'm expecting the market to then offer me a, so in the case of a double bottom, it goes up, back up, back up. Up here, which is 0.5, is where I'm expecting the market to start establishing a structure, which would most likely be a double top or a triple top, and then head back down again in the same way, right? That is, in short, the market cycle that we're looking to trade over the course of a week, right? So in saying that, I want to show you something else. Where is that? Here. A lot of the times when traders often look at something like this, they'll say, okay, Shiva, could this be a 1? And that's a pullback, that's a 2. And then we're going up again, that's a 3. Come back down, that's a 4. And then what went wrong here? Is this a 5 here? Why didn't the market reverse back? Usually, this is what's going to happen. All right, so we try and look for those massive pulls and pushes on a 1 hour chart. Right, so what we're looking for is, and it might not be clear, this would be first wave, up, second wave, third wave, and this is the fourth wave going up. This might be the pull back initially. That's 1, 2, 3. This would be 4, and that's 5 up here. So you're looking for it either on a 30-minute chart or a 1 hour chart, right? What tends to happen on a 15-minute chart is this. If you can see this clearly, is where you might have straight off a double bottom, the market climbs up, creates a 1, 2, 3, 4, 5, and this is where most traders will start going wrong, because they'll look at these tiny movements here, 1, 2, 3, 4, 5. Oh, sorry, the other way around, 1, 2, 3, 4, 5, and they would say, okay, this is done, it's 5, it's going to roll back again. Doesn't work that way. This whole thing here is a 1. Okay, so that's why we jump on a 1 hour chart and filter that crap out. But remember, on a 15-minute chart, you will get these tiny pullbacks. Okay, what I'm expecting in terms of these bigger pullbacks, if you draw your Fibonacci lines in, and this is what I practically use these for, so I use my fibs in and say we go all the way up to here. This could be where market goes up, pushes down, and hits either my 61.8 line, 50, or 38.2 or so. So in this case here, let's count this as 1. Market comes back down and hits either my 61.8 and goes slightly past it, hits my 50 or even the 38.2, and then bounces up. Then you could possibly count this as a 1. This would be the pullback to a 2. Right? So I have spoken about this also in previous videos when I'm talking about that when you're expecting this market cycle where there's going to be your double bottom, climb up, and then market comes down, and then you create like a V bottom or something, market goes back up, and then you can actually trade that market pushing up. I'm talking exactly about this. It's where market goes up, you have your slight pullbacks and push-ups and pullbacks, and then but eventually the market will do a fair correction. Now, depending on currency pair, especially for Forex, even this correction could actually be 30 to 50 pips. So you can actually trade this both waves, but remember that when you're seeing a double bottom and the market climbs initially, and the double bottom or double top has got to be at the start of the week. When the market climbs initially, you're expecting a correction, and then the market's going to climb up again. So it's the sky is really not going to fall out. So don't expect where you've jumped in somewhere here after a confirmation, like a nice big red candle, to say, okay, the market's just going to continue going south that way. It won't. This is why we say collect your 25, 30, 50 pips, whatever you want to collect, and get the hell out of there. Okay, so you could collect that here, and then at the same time, once the market is pushing back up like it is here, at some point around here, you could re-enter the market and take a trade going up, right? So here's something that a trader sent me this morning, John. I'm not going to say his surname, but mate, you asked me the question in regards to this false move. Why did the market fake these wicks to the low and come back down? Why didn't it continue going up? Now, here's the thing. This is what we're looking at, is you've got to look at not only what the market's doing right now, you got to look at it in the perspective of what's been going on throughout the day, and then start of the week. So this would have been your Tuesday, this would have been Monday, right? You got to look at it this way, that on Monday this is somewhat choppy, but you could have said this is somewhat of a a W bottom, especially when at the inception of this session here, which is London, market pushed back down, created a wick, and then started to climb, right? Say, for instance, we didn't take any trades there. The market climbed. What we're looking for is where the market does bounce back and hit somewhat of a low and then climb again, bounce back, climb again. So here, this would have been our 1, 2, 3, 4, 5, right? Market didn't push higher than any of these points, so that's the fifth point. And then what's going on down here is a downtrend. Somewhere within here is an M formation that the market's doing. So how we would notice it is that with the, and especially after here, guys, remember end of New York session, there's really not much happening there, so I wouldn't be looking for specific entry points at the end of New York, and also at the very start of Asian session either. What I would wait for is at least a few hours into Asian session to start seeing points to the high. So what I would be expecting from this point onwards is that there's every chance the market's going to come and hit a high and then continue going south, right? In this case, it's been a rough week where market really hasn't shown us very distinct patterns. This is the Euro CAD, by the way, on a 15-minute chart. Here, which is a bit of an evening star pattern towards the end of the Asian session, might be somewhat of a giveaway that the market's already planning on going south. I wouldn't take a trade straight off there. You could take these trades, yeah, on binary. Forex wise, I wouldn't. The reason for that is I'd probably wait for the Frankfurt or the London session to give me some sort of like a distinct giveaway that this is exactly what it's doing. Notice how it doesn't climb back up, doesn't give me a wick to the high before it climbs. So what it does do is it comes back down. This is the false move initially, okay? And then you start seeing wicks to the low. This is where a lot of traders will get confused and will start saying, is the market going to climb up again? Is it just going to continue going south? What is going on here? Remember what I said, if it's not entirely clear, don't trade it. I wouldn't have traded this. So what I would have done is waited for the market to climb back up, do its thing, and it's very slowly climbing up. You see a lot of wicks to the high, a lot of wicks to the low. This is Frankfurt session here, and then market pushes down, one aggressive move up, and then another aggressive move down. This is the first hour of the London session. Check to see if there's actually news there as well. If there is, then here's how I'm going to count this. I'm going to say, okay, this somewhere along here is a M formation that's happened, right? So you could say maybe this is the spike up, down, up, and then the market starts to come down. What I'm waiting for after this point in time is a clear. So this would be, this whole thing would then count as my 1 would be here. I'm waiting for a clear hit to the 2, right? So this could count as a hit to the 2 up here. This, hey Dave, this red candle here, once it pushes down, I can start looking for entries going south, right? So this 2, market pushes down. This is 3. This is 0.4 here. And this is the start of New York session. So here's the other thing. When I'm looking at this and I understand how the market cycle is working here, I'm not going to wait for a signal to push up, especially above this point. So, John, if you're watching this, mate, these wicks to the low, to me, suggests a couple of things. One is they're probably going to quite drastically move the market, and they're trying to fake as many people out as they possibly can. These are confusion candles. And if I can zoom in, if you have a clear look, see these 2 candles here. There's these wicks to the low, but there's wicks to the high here as well, and they're dojis, right? So they're pretty much consolidating for half an hour. You could say from here to here is roughly consolidation for 45 minutes or so, and that's just, they're sitting there doing nothing. They're trying to get to the impatient guys, and they're also trying to fake out as much as they possibly can, right? Zoom back out again. So once the market pushes up, what I'm waiting for is another wick to the high. So this was somewhat of an indication that the market was going to go up. Now, here's the thing, guys. This could have just consolidated for a while. and done nothing, and then they would have come out during the Asian session, then gone for a hit to the high, and then fallen. So what we're looking for, and where you would have started looking for opportunities, John, would have been where the market pushes up here, comes down. I probably would not have been trading until the market pushes down past these lines here, right? Now, this candle here, that probably would have scared the shit out of a lot of people, because it pushed up, and for a fair bit of time, if you guys can see this clearly, for a fair bit of time there, that would have been a nice long green candle. Here's how we justify taking the trade off of this, and if I could, which I can't, draw fib lines on this, and I would have waited for this to hit one of my fib lines, and then would have taken a reversal trade off of this. And I'll show you a trade that I have taken earlier today, exactly using the market cycle to take reversal trades, right? So I would have taken a reversal trade somewhere here. When this candle finished off in the red slightly, you jump into the next candle. Why? This is a massive indication that what these guys are doing here is, one, it's a stop hunt. So what Forex traders would have done is, after seeing this, the savvy ones, they possibly would have taken a short trade off of this, and here's the mistake: they probably would have put in a very tight stop loss somewhere along the lines. Here, what these guys did, look at this massive red candle. The dealers knew they were going to push the market south, right? So what they wanted to do prior to moving the market south is to cancel out as many trades that were going in the right direction. So stop losses were hit, people lost money off of this, and then they moved the market south. Okay, that's how we're going to start looking at the charts, guys. So again, going back to the video, I want you to start understanding market cycle in a specific manner. If you see a double bottom or a double top at the start of the week, then you need to make sure that this cycle is kind of completed. You need to be able to clearly look for the ones, the 2, 3, 4, 5. If you're stuck somewhere at a 3 and the market's coming down and hitting the 4, you know that using Fibonacci, the maximum point it's going to come back to is possibly somewhere between the 38.2 line and the 61.8 one. If it breaks past the 61.8 and then starts climbing again, you want to wait for price to come back to the 61.8 before you start trading it going up, right? So once it's doing that, then to me that says this is what it's doing. This is the bounce, right? If you can count these 1s and 2s and 3s and 4s clearly, and you get to your 5, then what you do is you're looking for wicks to change to the high, and then somewhat of a structural setup of a double top setup. So double bottom down here, double bottom down here, double top, or a triple top up the top here, and then for the market to then start bouncing back down this way. Okay, so to find this, guys, just go onto Google, type in Elliott waves on Google Images, and a ton of these images will start to come through. And this is what I want you to follow. Just look for market cycle going up, coming back, going up, coming back, going up, then wicks to the high, market's starting to establish a double top, and then the same thing reverses. So then you have, see, as is the case here, you have coming down again, going up, coming down again. Now, where you're looking for trades, actually, what I'll do is I'll put this into the next video, which would be best time to take trades and best time to apply strategies. So I'll jump into that, but just for the purposes of this video, I want you to start understanding how the market moves in terms of cycle, and apply the knowledge that we have with Elliott waves to then trade. Okay, and I will run you through what I did with my strategies for this, my trades for this morning, and how I traded them in the next video straight after this one. Okay, all the best.